I'm Prince Dykes. This is the Royal Financial Investment Group. Okay, I'm going to do a quick video today in response to one of the comments that was left below one of my previous videos that I think I released yesterday. The question was, pretty much they are coming to, get into the market, or they want to start investing. And as a smart person does, they do their research, and they've been trading with fake money or simulated markets. If you don't know what simulated markets are, they're pretty much when you can, essentially use fake money and trade with simulated markets, which is you're trading with fake money against the real market. So you can go in and pretend to buy Verizon stock and make positions, and you can see how they turn out, no cost to you, just to get your experience level up. But as the gentleman is doing, he's very smart. He's doing his research, and he's like, hey, I have this opportunity to where I'm able to get into the market, but I want to do my research, and I also want to know what the risks are in, with coming and investing. But before I go any further, just in case this is your first video, my name is Prince Dykes here. Drop a comment below. It's the quickest way to get in contact with me. Drop a comment below, and I'll definitely get in contact with you. Don't forget to like, subscribe, comment, share, all the other good stuff. Pretty much, you want to get in contact with me. My email address is Prince, P-R-I-N-C-E, at royalfinancials.com. You can drop a comment. You can email me here, things like that. So that's pretty much it. Thank you for watching. So today I'm going to get straight into it. The topic is market risk. What risk do you take when you're investing in stocks, right? There are two categories that you are subjected to when you get into the stock market. But before we even get into the risk of the stock market, let's talk about investing, right? Number one, the cardinal rule is that no risk, no gain, right? No risk, no gain. If you're not out there taking that many risks, your gains are going to be minimal. For example, look at a checking account. A checking account draws very little interest, right? Because there's nothing that you're really putting at risk. Your deposit is backed by the FDIC, right? You go into a savings account. A savings account draws a little bit more, but not that much, right? But if you go to a CD draws a little bit more than a savings account, because you lose, we're going to get into the different types of risk, but pretty much you lose control of the money because you have to lock it away for a certain period of time, maybe a year or two, to get that interest. But if you go into, let's say, a bond, for example, a bond, you're taking a little bit more risk. With a bond, let's say that company issues you a bond, you buy that bond, and let's say that company goes out of business. Or a debenture, you buy one of those, that company can go out of business. So you can make a little bit more interest. When you buy a stock, you can make a lot of money, or you can make a significant return on investment, but you're putting yourself at a lot more risk. So if you look at investing in a stock all the way back down to a savings account, you will see that it's you can make more money going to the stock side, but you're going to take a lot of risk, right? So I want you to understand that with gains come risk. If you're out there making crazy investments with little to no gains, then that's not a good investment, right? That's the only reason why do people invest? To make money, right? Or to preserve capital, either way, but most of the time it's to make money, which is understandable. So we're going to get straight into the risk that you absorb when you buy a stock. There are two categories. The first category we're going to jump into is called unsystematic risk, right? And unsystematic risk means it's unsystematic risk is pretty much four things. You have a business risk, right? On the unsystematic risk. Unsystematic risk can be avoided through diversification. You know what diversification is? That's spreading your money out, spreading the portfolio out. You just don't go all into the retail industry. You just don't buy just Macy's and just Walmart and things like that. If the retail industry gets slammed, guess what? Your portfolio could be lost, or you can be hurt significantly by just having maybe one stock, right? If you put all your money into Apple and Apple files bankruptcy, you could lose a lot of money real fast, right? So that's business risk. And the way to get away from that is diversification. The next thing is regulations, regulation risk. For example, tax laws. The government comes out and say, hey, we're going to raise corporate taxes. Every time you hear an election season come around, we're going to lower taxes and blah, 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 whatever, right? So let's say they say on corporate taxes, we're going to raise corporate taxes. That means the corporations have to spend more of their money. That means that shareholders can lose value and things like that. So by tax law, or if interest rates go up, those are different things, right? So for example, regulations of, they come out and say, hey, you know what, this business, we don't like the way you're operating, you no longer can do this, and they make it tighter for the business. That can hurt their liquid, that can hurt the amount of money, right? That's called regulation risk. The next one we're going to discuss is political risk. Political risk, most of the time, is for overseas, countries that are unstable. Let's say if you go and buy stock in a foreign exchange, not foreign exchange, but let's say you buy a stock, ADR over in Brazil, for example, and the government is overthrown and things like that happen. That's a political risk that you take, that you can lose all your money because the country may not be stable. So that's another thing that's called political risk. The last one up under unsystematic risk is liquidity. Liquid. The term is pretty much, one second. Liquidity is pretty much saying that I don't know why everybody wants to call me as soon as I start recording videos, but that's okay. But liquidity, the last one, liquidity is pretty much, hey, how fast can I sell something? How fast can I get my money out? How, let's say if, hey, I need to go get my money now. Things hit the fan, I want to get my money now. Can I get it out? Is there somebody else that wants to buy it, right? So that's a liquid risk that you possibly could take depending on what type of investment you make. And you can look at a lot of liquid risk if you get into stocks is by volumes. How many are brought and sold? Pretty much the biggest thing you want to look at is the volume. How often does that stock move? Is it just sitting there and it has zero volume? Right? That's a risk that you take. And I also seen that's what I was talking about. Hey, what about these boiler room stocks? What about these companies that are made out of anywhere? My number one way to get around that is invest in the shit that you know about. Excuse my profanity. But if you don't know anything about it and you never heard of it, you can't find any information, you do your research and know nothing about it, I will leave it alone, right? That's fundamentals. The fundamentals, if you don't know about it, you just don't invest in it. Now the technical side of the house may look at volume and trend analysis, how did it perform in the past, things like that. But that's a risk that you take. That's the way to get around it. You don't know nothing about the company, you never heard of it, it just comes out of nowhere, just getting all this press, you don't believe in it, just don't buy it, right? So now we're going to go into systematic risk, which is systematic risk. The difference between systematic risk and unsystematic risk is systematic risk cannot be avoided. There's nothing you can do to avoid systematic risk, right? So the number one thing is market risk. Market risk, like you just seen my last video. What was my last video called? I can't think of it off the top of my head right now. I got so much running through my head. But if you look at my last video before this one, I told you that the market does three things. It goes up, which is considered bearish. It's considered bullish, or it goes down, what is considered bearish, or it moves sideways, which is considered consolidated. So it goes up, down, sideways. But as we know, over time, the market does this. It just doesn't go it goes up, down, things like that. So as it's going up and down, let's say 2007, right? This is considered a market risk. The whole market pretty much crashed. And you've seen that the financial industry went down, the retail industry went down, the real estate industry went down, the automobile industry went down. A lot of things, unemployment started to increase, gas prices was going up. So it's like a domino effect. When once went down, all went down. It was nothing you can do to really avoid that, right? Now you could make money in that type of situation if you buy put contracts, but there's nothing you really can do to avoid that. The number one way you can avoid it is you can bet against yourself, which is called buying puts. Let's say, for example, you own 100 shares of stock. You can also use a put contract to hedge yourself, just in case that stock takes off and go down. I'm not going to get into calls and puts and things like that on this particular video, but you can hedge yourself by using option trading. Another thing is interest rates. The government controls interest rate, right? The Federal Reserve Board pretty much controls interest rates. And we all know when interest rates go up, bonds go down to a discount, right? So if, let's say, if interest rates increase, the money gets tighter, banks don't have that much money, that can hurt investments. You can't do anything to really avoid it. It's just systematic, right? Inflation risk. Inflation is the price of it. For example, I'm 30 years old. I remember when I was in high school, 11, 12 years ago that I can take $1 and go to a vending machine and get 2, maybe 3 items. Now with $1, you go to a vending machine and they laugh at you. You'd be lucky if you get 1 item, right? So it's just that inflation, the price of everything is going up. And how that hurt an investment is that, for example, let's say if you put your money, let's say today I take $10,000 and I put it inside of a CD, which is great. But say if it's a 10-year CD, 10 years from now, let's say $10,000 doesn't have the same purchasing power that it will from 10 years from now. Let's say the price of things go up. You know, let's say 10 years, in 2000, for example, let's say you had $5,000 you put inside of a CD, that might be a nice piece of money. But if you keep going and you look at it now in 2014, it's kind of like, 5,000, can't really do too much. That's because of inflation. The price of everything is going up, right? So that's something to think about. So I discussed unsystematic risk and systematic risk, right? And I also just spoke over investing all together in risk, you know, absorbing risk. But the cardinal rule is no risk, no gain. If you're not willing to take any risk, pretty much you're in the wrong business, or you're looking into the wrong thing. But if you look at it, it's no way around investing. Let's think about it. If you're not going to start your own business, or if you're not starting your own business, that's a risk. That's an investment. If you get into real estate, that's an investment. You get a 401k. Guess what? That ties all into the stock market. That's an investment. Bonds, mutual funds. Mutual funds is nothing but a bunch of stocks, essentially. CD, corporate bonds. Those things are all investments. You know, even when you go out and buy a car, buying a car is an investment. Oh, I don't really look at it that way. If you buy a car and it breaks down on you and you have to buy another one, then you just lost your investment because you still have to pay for that initial car. So pretty much I look at it, there's no way around investing if you want to grow, right? And if you want to invest, there's no way around risk. You can minimize risk, but you can't completely eliminate it. If somebody says, hey, I got an investment, you can make an investment with 0 risk. Look a little sideways, right? With 0 risk and you got 100% liquid, just look at it sideways. You should be wondering about that. So unsystematic risk, you can't avoid that through diversification. Diversification means spreading your money out through different sectors, right? Systematic risk can't be unavoided. The market is going to go down and it's going to go up. Just like in my last video I discussed, I said, hey, listen, right now I feel that we're in an expansion. You know, unemployment is down. Gas prices is down. The stock market is trading at an all-time high. That means people have jobs. They're not spending their money at the pump. Guess what they're going to do with their money? They're not going to say, oh, well, I'm saving extra money now. Let me go pay off this bill. Some will, but majority will go out and buy things, which means the real retail industry will probably start to boom. So retail or things like that, people are going to pump their money back into the economy. So, but after an expansion comes the peak. And when you get the peak, what comes next? Contraction, recession. It's natural. You know, the market just can't keep going up, up, up. It's going to have a slide time. But if you look at the market over 30 years, people say, I don't know about the market. It crashed and it boomed and it crashed. I don't know about that. It's all a scam. It's all a scam. I don't understand it. But if you look at it overall over 30 years, you will see the market has gone up overall. Yeah, it has its dips and it has its peaks and it has its valleys and it goes into its troughs. It does this and it moves sideways. But overall, if you look at it over 30 years, it has slowly increased. How else can you get around that? Numbers, right? People lie, numbers don't. That's what I go by. Anyway, I know this is part of the video where all my true and real fans are. So just talk to you guys as always. I always leave you guys something to get personal with you guys at the end of the video. Pretty much, I'm studying for my Series 63 exam, which is the Uniform Security Agent State Law exam. You're ready to take that on the 24th. Just a couple weeks ago, I passed the Series 65, which is the Uniform Investment Advisor Law exam. So I was successful on that one. I'm taking Security Agents exam. Next, I'm going to start doing events. So going to community centers and stuff like that while I'm out here in Hawaii. If you want me to do an event for you or something like that, drop me a message, a comment, or something like that if you're putting together a situation. I'm going to be getting into those type of things when I have the time and when I can. I'm going to continue to get better and better and better, and I'm going to continue to grow Royal Financial Investment Group. Been around for a little while now, so you can go back and you can see one of my first videos to this video, And I've been around, I keep doing it, and I love it, you know. And thank you guys for supporting. Keep liking and commenting, subscribing, all that good stuff. This is my vision, my dream that I saw, and I'm glad that you guys are taking to it and, you know, supporting me and coming along with me on this journey. So anyway, thank you guys. Don't forget, like, subscribe, comment, share it with a friend, tell your brother, tell your cousin, tell your coworkers, tell everybody. Be safe. Until the next time, I'm out.